Hi there, Brock VandenBerg, President of TaliMar Financial and Fund Manager of TaliMar Income Fund I. Today, I'm excited to be presenting the monthly returns for last month. On the agenda today, we're going to talk announcements for the fund. We're going to talk some notable statistics. We're going to give a quick brief overview of the fund for those that may not be invested and may be interested in learning more. We'll talk some fund stats and updates. And we'll talk a little about what's going on in the market. Fed just announced that they were lowering the Fed funds rate by 50 basis points. We'll talk a little about how that's going to impact the fund. And then we'll respond to some common questions that we are getting. So let's go through the quick announcements. Number one, return for the investor in the month of August, annualized was 9.37%. So very healthy return. Above what our target yield is our yield for the year. I think currently right now our average year-to-date return is about 9.5%. In August, we funded 12 loans totaling 11.4 million. That was the third straight month in which we funded over 10 million in a month. That's exciting. Third bullet point, we added 2.27 million in new investor capital in August. So the fund continues to grow. We surpassed over 100 million in total assets under management. So that includes not only assets within the fund, but we do have some legacy assets outside of the fund. So it's a big milestone that we accomplished. And I know the group is really excited about that. And then we attended the California Mortgage Association biannual event in Newport. I got an opportunity to moderate a panel on the fund manager's state of the union. So we brought up some of the bigger vendors that really assist fund managers like myself, like CPAs, attorneys, and then also loan doc providers to kind of talk about what's going on in the marketplace. The next California Mortgage Association event is, I believe, March. It is in the desert, and it's actually during the big tennis tournament out there. If you're interested in learning more, go check their website out, California Mortgage Association, and get a ticket. So real quick about the mortgage fund, for those that may not know about the fund, we are a debt fund. We established this fund in 2021, so we're in our third full year. We focus on funding first position loans on non-owner occupied residential, multifamily, and commercial real estate. Vast majority of our portfolio is located here in the San Diego marketplace, but we do fund all over the state of California. Currently in the fund, we have over 100 loans, totaling about 84 million. Total loans funded to date within the fund, we funded 279 loans, totaling over 208 million. So we really got some track record. Strong track record of loans coming through the portfolio. Year-to-date return 9.51% with over 300 investors in the fund. So we continue to grow. I like it. Let's talk loan origination. So in August, we funded 12 loans totaling over 11 million. As I had mentioned earlier, that's the third straight month in which we funded over 10 million in a given month. Average rate of those loans were at 10.5%. Average loan size is at 951,000. I think that's probably a record for average loan size. And the reason why I like to kind of highlight that is as a mortgage fund, we do have the ability to go after larger loans. And the reason that's important is because there's usually less competition at that larger loan level. Now, you know that when I was doing individual trustee, it's about the max loan size you could get is around $1 million to maybe $1.5 million, just because you couldn't just aggregate enough investor capital for any one loan. But as a mortgage fund, and you're aggregating all that investor capital into one fund, you're able to pursue larger loans. And for us, again, what we find is that the larger loan size, there's less competition, and so you can price a little better on those loans. Average loan to value ratio is at 63.84%, so we're below that 65% LTV ratio that is our target for the fund. Average duration is 12 months. So to give you kind of an idea of closings compared with prior years, again, in August, we were about 11.4 million. August 2023, we had 7.5 million, and then in August of 2024, 2022, we were at 3.9 million. So we are growing quickly, and it's exciting to see that growth. Here's an example of a recent funding that we did. This was a bridge loan secured. This is actually an Airbnb property. Actually, it's 3 separate units in one property. The property is located in Ramona. Loan to value ratio at 65%, 18-month term, 10.5%, first position loan. So this is a very prototypical type loan that we are funding. So let's talk loan servicing. Loan servicing, right now we've got 100 loans in the portfolio. This was at the end as of the end of August. Total outstanding balance at 83.9 million. So that's an all-time record, highest outstanding loan balance we have had. Average loan size within the portfolio is around 839,000. So if you remember, in terms of closings, the average loan size was around 950,000. So those loan sizes are progressively getting larger. Average portfolio yield right now is at 10.57%. Interest income, so this is the gross interest income that the fund earned in the month of August, and then we would take out our fees, was 753,000, a little over approximately 754,000. Total non-performing loans as of the end of August was totaling 1.2 million. But I am happy to announce that we have 0 non-performing loans. So the 2 loans that were non-performing worked out with the borrower, brought them current. They were actually maturity defaults, so brought them current. So we have 0 non-performing loans in the loan portfolio. What we show here is our loan table showing the balance of the portfolio over the last 12 months. So in the month of August 2023, this time last year, we had approximately 60 million in the portfolio. And now we are about 84 million in the portfolio. So again, we're seeing good, solid, healthy growth within the portfolio. Our goal within the fund itself, our goal is to be at 100 million by year end. So let's talk about what's in the loan portfolio. What makes up all of the loans in the portfolio? Obviously, that's important. That gives us a perceived risk of the portfolio. So what we have is over here primarily what we call fix and flip loans. So these are loans where the borrower acquires the property, renovates the property, and with an exit primarily to sell the property. And what's interesting about these loans is that we provide purchase funds for them and then also renovation funds. And then over the course of the renovation, we'll go ahead and issue funds to the borrower based on work done. And then once it's done, release the remaining funds and they go to sell the property. That is really kind of how our company was started, providing these types of loans. So that makes up roughly 57-58% of the portfolio. The other big percentage is bridge loans. So these are just acquisition or refinance of existing loans in the portfolio. There's no real value add to them. Why they're a little different than fix and flip loans? Bridge loans have a tendency to stick on the portfolio longer. So it's really hard to build a larger portfolio when you have fix and flip loans in them because you're just burning through them so quickly. They're only on the portfolio for, maybe 5, 6, 7 months. So, if you don't have a lot of capital, they're great loans because you can kind of churn through loans. But as you grow of a fund, you kind of grow up and mature into more and longer term bridge loans. And then we have about roughly 13% in new construction. So these are ground up construction loans. By property type, as you can tell, overwhelmingly still single family. I like the single family product. The reason being is that, if you're going to go into a recession, you better if you're invested in real estate, have single family homes. Everybody needs a house, a roof over their head to live. Or, if you can't sell it, you can always rent it. So we just really focus on SFRs. Second biggest property type is going to be your multifamily, and then get into some of that commercial type real estate. So industrial, assisted living, retail, I think one manufactured home, and then one office as well. All right, let's move on to our investor relations section. So as we've kind of hit on prior slides, total investor capital within the fund is at 85.72 million. Again, that's all-time high. Total number of investors, 306 existing investors. Year-to-date net yield is at 9.53%. Total loans at 100 loans. Outstanding balance at 83.915 million with a weighted average coupon of 10.57%. So when I say weighted average coupon, that's the average coupon rate before servicing fees and fund admin fees. Again, 10.5% I think is an all-time high. 83.912 million is an all-time high, and 100 loans is an all-time high. So I think one of the questions that we're going to talk about later in this deck is, Brock, are you guys set up for this kind of growth? And the answer is yes. Number one, we've been doing this for over 15 years, but now we have a full-time dedicated loan servicing specialist within our organization that really works hand in hand with our loan servicer to make sure that we're boarding loans correctly. If there's any borrower questions that come in, we can answer them quickly. Loan draws and whatnot get out quick enough. So we have a full-time loan servicing specialist that can that can manage this type of growth. All right, so what this slide shows is the total investor capital invested in the fund over the last 12 months. So if you look on the left-hand side, what we have is shows our total investor capital in August of 2023. That was just shy of 60 million. I think we're about 58 million. And then the growth of investor capital over the next 12 months. Currently, we're here at that 85 million. So again, we've got good, steady growth that we can definitely build into. About 6-7 months ago, we hired on a full-time investor relations person to assist us with new investors, boarding them, handling the new subscription requests, answering any questions, responding to any document requests and whatnot. So she's done a wonderful job. Susan, you've probably worked with her, but she's been a great addition to our team. So let's talk return comparison. So what are alternative investments that we can compare the return of our fund to? And this is where I want to start talking about the Fed funds rate. As I had noted yesterday, the Fed had announced that they are going to lower the rate by 50 basis points. Personally, I thought they were coming in at a quarter point, but came in, showed their hand, came in with 50 basis points. Want to make sure that the market knows that they're very focused on maintaining a healthy economy. So, but with that being said, we don't tie the return of the fund to the Fed funds rate. In fact, we prefer to use the 10-year Treasury. And on what this graph shows you is the return of the fund over the last 12 months. And what I wanted to highlight here is in green is that 10-year Treasury. For those that are not familiar with the 10-year Treasury, 10-year Treasury is a bond note that the federal government sells to outside investors, essentially selling their debt. And is a good barometer on how much risk there is in the market. If there's a lot more perceived risk, that the interest rate that is charged will go up. People perceive it as more risk, therefore they want to get a little higher return. If they perceive it as less risky, that return of the Treasury will go down. So we typically, and when I say tie, we typically trend closely with the 10-year Treasury. And usually we're about 500 to maybe 525 basis points above the Treasury. And that's kind of what you'll see here is this. There's a relative correlation between that and the Treasury. What the other purple line here is the S&P 500 bond index. Again, it's another thing that we can track, but if you're going to say, okay, what my expected return over the 10-year Treasury, you can probably be safe to say around 500 to 525 basis points over the 10-year Treasury. So let's talk market update. Let's talk on a national scale. Housing market still remains pretty healthy, and I assume it's going to remain even healthier with lower interest rates. Now, keep in mind that mortgage rates have already declined. They were declining months ago with the general market thinking that the Fed was going to be lowering rates in about by 50 basis points, which is why you actually saw mortgage rates kind of jump when they made the announcement, because there was maybe a subsection of the market that felt that they were going to dropping it by 75 or 100 basis points. But generally, the housing market remains strong. If you look at the top side, median home sales price for a home here nationally was at $433,000. That's about a 3% increase year over year. Number of homes sold, 463,000. That was actually a decline, year over year decline of 5%. Again, I wouldn't look too much into this. There's a lot of seasonality into the sale of homes. So when you're talking about, August, you're kind of at that the tail end of when homes are selling. Number of homes for sale currently in the marketplace. Now, this is interesting. We have 1.8 million homes for sale, and that's a 14% increase over this time last year. However, again, it's hard to say if this is something an anomaly, because this time last year, there was a historic low homes sold. So any movement off the absolute base or floor is good movement. There's more homes for sale, so there's just more activity. I would not read too much into that. Days on market, about is it 37 days on market for those that are currently listed. Pretty low. I mean, when you can really get up to 45 days and still have a very healthy market. But you do have an increase in the number of days on the market, and that's probably expected with an increased number of homes on the market. Also, it'll be interesting to see if there were buyers in the market that were waiting to purchase just to see if rates were going to go down. We'll see if that has any factor into looking at these numbers over the next couple of months. Current homes on the month's supply on the market is roughly 3 months. Again, healthy, and that was no change from this time last year. California home stats. Median home sales price is at $818,000. That's a 3.3% increase from this time last year. Number of homes sold did decline by just shy of 5%, or 25,000 homes sold. Again, historically, that is very, very low for the state of California. Days on market, 33 days, so very healthy market. There's actually an increase of 7 days for this time last year. Again, we were at in terms of availability of homes this time last year, we're near zero. So I wouldn't be looking too much into these stats because we're just coming off historic lows. Same thing with number of homes for sale. So yeah, we saw a significant increase in the number of homes, over 20%. But again, we had no homes on the market this time last year. Months of supply, 3 months of supply. Again, no change there. And sale to list price, which is interesting. Homes are still selling for more than what they're being listed for, which again, I find fascinating because I feel like I see more and more prices being cut these days. But there was an insignificant difference between this time this year and this time last year. Let's look at San Diego home stats. So median home sales price at $971,000. Again, a slight increase from this time last year. Number of homes sold, 906 homes. Can you imagine for this is the month of August, there were only 900 homes sold in the month of August. Days on market, 33 days. So again, very low, very healthy. Sale to list price, slightly below what homes are being listed for. I think you're going to see this number starting to rise. You're starting to see a lot more home prices being cut to get them moved. And I anticipate seeing this number here, as soon as home sellers start to get a real understanding of the true value of their house, we'll start to lower prices. All right, let's talk real estate in the news. This is where I talk about an interesting subject that's currently in the headlines regarding real estate. Today, obviously, everybody is talking about the Fed and the half-point drop in the Fed funds rate. As we talked earlier, the Fed funds rate or the fund return isn't tied exactly to the Fed funds rate. That's tied more to the 10-year Treasury. What the Fed funds rate really is the rate that the Fed charges banks to lend amongst each other. It really impacts or is more generally to control the growth of the economy. Isn't really there to control what rates consumers are being charged, unless you're talking about super short-term rates like credit cards. The longer-term debt, especially mortgage debt, is more tied to the 10-year Treasury. But what it does say is that the Fed does believe that the inflation that we were dealing with last year and earlier this year is behind us. We do see some weakening in employment, but I don't see anything to be concerned about. You do see home values really starting to plateau. Again, it's not something that I'm overly concerned about as we went through the numbers before. I just say that generally that this was expected. Half point was pretty aggressive. Though I felt that the Fed was going to come in with a quarter point, being that it would give them a little more room if they needed to control the number of reductions that they're going to have. But they came out of the gate, they came strong with a half a point. The market liked it. You saw the market even jump today considerably on this news. All right, let's talk discussion points. Now, discussion point number one, how will the recent Fed impact investor returns? I kind of feel like we've really addressed this question. Number one, the return of the fund isn't directly tied to the Fed funds rate. It's more tied to that 10-year Treasury that we talked about, and we kind of showed that graph. I think the 10-year Treasury demonstrated the kind of the increase in rates there, demonstrated the expected cut that they thought the Fed would have. Personally, I thought, again, a quarter point was going to be where the Fed was going to be, but they came in strong with a half point cut. But again, I think that was already priced into the return of the fund. We do anticipate future Fed cuts, probably at the quarter level range, depending upon kind of what inflation numbers come in the future and kind of where employment numbers are. But that will impact the return of the fund longer term. I do feel that we will be hitting at least our expected return, if not higher, of 9% by the end of the year. Changes to expect in 2025. Number one, I anticipate really focusing on larger loan sizes, as we talked a little earlier in the slide deck. When you get into the larger loan sizes, there's just less competition, and so you can kind of price your debt a little better. Number two, you kind of have a stronger borrower type, more sophisticated borrower with more sophisticated, we'll call sophisticated real estate. So you can create a much healthier loan portfolio by really financing those more sophisticated borrowers. Bullet point number two, really focus on longer term loans. So as we get closer to $100 million portfolio, it's really hard to replace those loans churning through short-term fix and flip loans. So we're going to introduce some longer term loans, maybe 24, 36 month terms. Now in the past, I wasn't keen on doing longer term loans because I had anticipated rates to go up. Just based upon what I see, general economy, the health of the economy, I just don't see us seeing a high probability that we're going to see a higher interest rate environment here in the next 24 months. So might as well lock in some loans now, a little longer term that might be paying higher now, so that if rates do decline, at least we can offset those declines with some legacy loans that we have on the portfolio that are paying a little higher. And number three, really kind of focus on just reducing costs generally. So our loan servicing costs and our fund administration costs, and getting them as a smaller percentage of our overall portfolio, so we can return more to our investors. So those are the two main discussion points that I wanted to cover today. All right, so another question I get, here's some common questions that we're seeing. Number one, how do I log into the VeriVest portal? Well, number one, super easy. All you have to do is go to our website, go under the drop-down menu, Invest, and it says Portal Access or Log into Portal. Just go ahead and select that on the website, and then you go directly to the VeriVest portal. Who is VeriVest? VeriVest is our fund administrator. They're the ones that do all the back-end accounting. They're the ones that put together all of your bank or all the statements and whatnot. We've essentially outsourced that function for the fund. So we call it the TaliMar Financial investor portal powered by Verivest. So when you log in, it looks like it's TaliMar Financial, but it's at the end of the day put together by Verivest. Number two, where do I find my account balance? On the Verivest portal, super simple. When you log in, go to the dashboard and you're going to see your balance. Now, one thing we are working with Verivest is that your balance only gets updated once a month. So if you have added funds to your account, they are not going to appear until we've completed that month's accounting cycle. And then at that point, when we post your account statement, they will update your balance on the portfolio. So we are working with them to make it more real time, because I know some people kind of get confused when they invest and then they don't see their account balance increase. Number three, how do I add funds? Very simple. Reach out to my investor relations team at any time, or you can go on the website under investor, that same drop down menu, and it should be add funds, and you just simply submit your fund request. All we need to do, if you're already invested, is just going to send you an updated subscription agreement. You sign it, submit your funds, and we'll get those invested for you. Where do I find the 20% QBI tax deduction figure? So I get this question a lot. When you get your K1 at the end of the year, on page 2, you're going to have a box, and I don't know what box it's numbered, but it's going to say income that qualifies for the QBI tax deduction. It's going to be right there. Your CPA or accountant is going to know exactly where to find it right there, and they'll be able to put it into your tax return. If you have any further questions about that, I'd be more than happy. I can share a copy of the K1 that I issue for myself for my investment in the fund, and I'll show you exactly where it is. PowerPoint number 5, how does the portfolio look? I'm happy to announce that the portfolio is extremely healthy. In fact, we have 0 loan defaults in the portfolio right now. But if you ever have any questions about the health of the portfolio, feel free to reach out to my investor relations team. We'd be more than happy to share with you kind of what those stats look like. But we're super excited. No defaults in the portfolio currently. Promotions. Thank you for everyone that hopped on that $1,000 promotional credit last month. We had a lot of loans getting funded, so we had to raise money quickly. Currently, we've got a $250 referral bonus. We get surprisingly a lot of referrals. So if you refer somebody, we'll go ahead and either add $250 to your account if you like that, or we'll go ahead and give a referral bonus if they open an account. So they don't have to invest. They don't have to invest. All they have to do is open an account with our organization. All right, that about does it with our September update. For those that made it this far, thank you for listening to the entire deck. We're excited about the future. We're excited about the current health of the loan portfolio. If you liked this and you're watching it on YouTube, go ahead and give it a like. Remember to go ahead and subscribe to our channel. We post a lot of great content. If you've got any questions, feel free to reach out to me. I'd love to answer questions or get your insight into what we're talking about. I got my contact information here, email address as well. And if you're just interested in investing in a fund or got questions about the fund, feel free to reach out to me or my team, and we'd be more than happy to answer those questions for you. So thanks again for listening, and look forward to giving you an update next month.